Hey everyone, welcome back to Corporate Decoder. Today we're diving into Spirit Airlines' latest financial report, and let's just say it is a roller coaster. If you thought your last Spirit flight was bumpy, buckle up, because their financials are telling a wild story of big challenges and even bigger bets. And hey, before we take off into these numbers, if you love uncomplicating complex corporate news, make sure you hit that subscribe button. Also join our Discord community for even more insights. Link is in the description below, and let's get decoding. Alright, first up, let's look at their latest financial picture, specifically the 3 months that ended the 30th of September 2025. Spirit brought in revenue of $958.5 million. That sounds like a lot, but it is actually a pretty big drop compared to the same time last year when they made over $1.1 billion. Think of it like losing about $1 in $5 they used to make. And this revenue drop really hit their bottom line. They ended up with an operating loss of $134.9 million. That means they spent more running the business than they brought in from flights. Now compared to last year's operating loss of nearly $296.4 million, it is actually an improvement. So they are spending less, but they are also bringing in a lot less business. Looking at the bigger picture for the 9 months ending the 30th of September gives us an even clearer view. Their total operating revenue was just over $2.2 billion. Last year, for the same period, they were bringing in over $3.7 billion. That is a massive decrease, almost a 40% drop in revenue from what they were making last year. This clearly shows the impact of their ongoing struggles and restructuring. Now, something interesting in their expenses is this loss or gain on disposal of assets. In the 3-month ending the 30th of September 2025, they actually recorded a huge gain of $113.7 million here. This sounds like good news, right? Well, it is mostly from selling off assets like engines and aircraft, often through sale. Leaseback deals. So they're getting cash now, but they'll likely pay more in rent later. It is a way to get money quickly when you really need it. Let's talk about debt. As of the 30th of September 2025, their long-term debt, not counting the part due soon, was about $750.2 million. That sounds like a lot, but look at December of last year. It was over $1.7 billion. So they've clearly made progress in reducing their long-term debt. This is a positive sign from their bankruptcy restructuring. But then we see this section, liabilities subject to compromise, totaling over $6.6 billion. This is a massive number. It represents debts and obligations from before their bankruptcy filing that are still being sorted out. It is a huge cloud hanging over the company, showing how deeply the bankruptcy is affecting their financial standing. Looking at their assets, their property and equipment like airplanes is valued at over $2.5 billion, but a big chunk of their assets, nearly $4.6 billion, is tied up in operating lease right of use assets. This means a huge part of their business runs on leased planes, and paying for them is a major ongoing cost. When you look at the liability side, the story gets more complex. Their total current liabilities are over $1 billion, but the real kicker is that $6.6 billion figure for liabilities subject to compromise. This is the scary part, showing how much uncertainty remains from their Chapter 11 bankruptcy. And then there is shareholders' equity deficit, which is actually a positive $164.5 million. This is a big turnaround from a deficit last year, likely due to the restructuring and fresh start accounting after bankruptcy. Now, the most telling numbers are the profits and losses. For the period from the 13th of March to the 30th of September 2025, they reported a net loss of over $574 million. And that is after the bankruptcy for the first part of 2025. Before the debt restructuring, they had a profit of about $72 million. But when you combine it all, for the 9 months ending the 30th of September 2025, their net loss was a staggering $643 million. This shows how much the bankruptcy and restructuring are costing them, even though they are technically a new company after emerging. Let's look at how they are using their planes. For the 3 months ending the 30th of September 2025, their average daily aircraft utilization was only 7.3 hours. Last year, it was a much healthier 10 hours per Dalton Y. That is a huge drop of 27% lower. This means their planes are sitting idle a lot more, which is a massive drain on resources. They're flying fewer flights, about 25% less, and the planes they do fly aren't flying as much. When we look at their costs, their adjusted CASM ex fuel, which means their operating costs excluding fuel, was 9.24 cents per available seat mile for the most recent quarter. That is up from 8.20 cents last year. Even excluding the big fuel bill, their core costs are going up. This is a warning sign, especially since they are flying less. It suggests their fixed costs are spread over fewer miles, making each mile flown more expensive. Their salaries, wages, and benefits expense actually went down on its own by about $60 million. That sounds good, but on a per mile basis, it went up by almost 13.5%. Why? Because they are flying fewer miles. They are also furloughing employees, which means the remaining employees are likely more senior and thus more expensive. It is a tough balancing act. Aircraft rent has gone up by about $5.6 million. They're leasing more planes than last year. This is happening even as they are flying less. More planes, less flying, and higher rent per mile flown. That is a recipe for trouble. A big reason for the reduced flying is these Pratt & Whitney GTF engine issues. They've had to ground a lot of their newer Aviation Neo planes for inspections. This is a major operational headache and directly impacts how many miles they can fly. They're getting some credits from Pratt & Whitney, but it is not fully covering the costs and disruptions. And to make matters worse, just recently in October, they had to reject some lease agreements because of these issues. Now, for some truly concerning news, Spirit's stock has been delisted from the NYSE American. It is now trading on the OTC Pink market under the symbol FLYEEK. This is a huge step down and means their stock is much harder to trade, and the value has likely plummeted. They even say in the report that their old common stock will become worthless. This is a major red flag for investors. And the elephant in the room, their Chapter 11 bankruptcy. They filed for bankruptcy again, this time in August 2025. This is a huge deal. It means they are in deep financial trouble, and their ability to continue operating is uncertain. They explicitly state that their common stock will likely become worthless. This is a stark warning to anyone holding their shares. They are heavily reliant on loans and financing just to keep the lights on, and even then their future is far from guaranteed. The report repeatedly mentions substantial doubt about our ability to continue as a going concern. That is corporate speak for, we might not make it, so. What is the story here? Spirit Airlines is in a tough spot. They've emerged from one bankruptcy, only to file for another shortly after. Their revenues are down significantly, their costs are rising on a per mile basis, and they're flying a lot less. The engine issues are crippling their operations. And the bankruptcy again means extreme uncertainty for investors and even the company's survival. While they've made some progress in reducing debt and have new financing, the sheer scale of their liabilities subject to compromise, and the repeated bankruptcy filings point to some very serious underlying problems. The delisting from NYSE American is a clear sign of distress. In my opinion, Spirit is fighting an uphill battle. They're trying to cut costs and restructure, but the market conditions are harsh, and they've been hit by multiple operational crises. The fact that they are filing for bankruptcy again so soon after the last one is a major concern. It raises questions about their business model and their ability to manage their finances in the long run. The risks are extremely high, and while they might survive this latest bankruptcy, it will likely come at a significant cost, and their stock value is virtually wiped out. It is a classic case of a company struggling to adapt to a challenging industry environment and being unable to manage its financial obligations effectively. Alright, that is our deep dive into Spirit Airlines' latest SEC filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.